A tax write-off does not mean the government bought you something. A legitimate deduction may reduce the income used in a tax calculation. You still spent the money, and the expense still has to qualify. This video gives you a practical test for business expenses, explains mixed use and documentation, and shows why spending money solely for a deduction can be a bad deal. My name is Mitch Caldwell, your modern-day tax CPA, and I am a licensed CPA here in California. This is general tax education. It is not individualized tax, legal, accounting, or financial advice. Deduction rules depend on the expense, business purpose, documentation, timing, and tax year. See, the general federal rule is that a business expense must be both ordinary and necessary. An ordinary expense is common and accepted in your field of business. A necessary expense is helpful and appropriate for the business. It does not have to be an absolutely indispensable. Ordinary and necessary are broad standards, but they are not magic words that turn any purchase into a deduction. If you want tax explanations that are practical without becoming reckless, subscribe to Modern Day Tax CPA. You want to start by asking what the expense actually did for the business. Software used to complete client work, advertising intended to find customers, and supplies consumed while performing the work may have a clear business purpose. A personal purchase does not become a business expense merely because you use the business card or mention the business while buying it. The actual use, business connection, and applicable rule matter more than the label placed in the bookkeeping software. Many expenses are partly business and partly personal. Common examples include a phone, internet service, vehicle, or equipment used outside the business too. A personal portion is generally not deductible as a business expense. The business portion needs a reasonable, supportable allocation. The hard part is not typing a percentage into a tax software. The hard part is maintaining records that show how the percentage was determined. If an item is used 60% for business and 40% personal, claiming 100% business use because the receipt is in the business folder does not fit the allocation. Having a receipt proves that money was spent, but it does not always prove the business purpose, the business use percentage, or the correct tax treatment. Good records identify the date, amount, vendor, item or service, the category, and business connection. Some expenses require additional substantiation. Document the reason why you still remember it. Reconstructing an entire year from a bank statement during tax season is a miserable hobby. Trust me, I know. An electronic system is fine if it clearly shows income and expenses and preserves the supporting documents. The best system is one that is accurate, orderly, and actually maintained. Now, suppose a qualifying business expense costs $1,000. $1,000 still left the business. The deduction does not normally create a $1,000 refund. It may reduce taxable business profit, which may reduce taxes depending on the complete situation. Spending money solely to create a deduction can still leave you with less cash. Buy what helps the business, not nonsense someone called a write-off. Compare two $1,000 purchases. Software used only to deliver paid client work may have a direct business purpose. A personal television placed near a laptop does not become business equipment because an email was answered beside it. The price is the same, but the facts are different. The tax answer follows the business use and applicable rule, not the dollar amount alone. Vehicles, travel, meals, home offices, equipment, startup costs, and large purchases can involve detailed limitations, substantiation, capitalization, depreciation, or special expensing rules. For example, the home office deduction has specific requirements. Paying household expenses does not automatically make part of the home deductible. Equipment may need to be depreciated or handled under a special expensing provision rather than treated as an ordinary immediate expense without further analysis. This is why the question is sometimes not only whether an expense is deductible, but when and how the cost is recovered on the return. Before a large purchase, write down the business purpose, expected business use percentage, useful life, and documents you will keep. That short exercise often exposes a weak write-off before the cash is gone. The 5 most common mistakes I see are as follows. Mistake number 1 is deducting personal spending. Mistake 2 is keeping receipts without documenting the business purpose. Mistake 3 is claiming unsupported 100% business use. Mistake number 4 is assuming every purchase is immediately deductible. And mistake 5 is believing that the most aggressive answer is automatically the most professional answer. So the useful question is not simply, can I call this a write-off? But you have to ask whether the expense is ordinary, necessary, connected to the business, properly allocated, documented, and handled under the correct rule. Next, watch the self-employment tax guide because legitimate business expenses can affect net profit, and net earnings are central to understanding self-employment tax.